Hello and welcome to this interview series where we bring you face to face with the people who manage your money. Today, joining me and my colleague Chirag is Dhimant Kothari, Senior Mutual Fund Manager at Invesco Mutual Fund. Welcome, Dhimant.
Thank you.
Now, why don't we begin this interaction with you sharing with our viewers what first sparked your interest in equity investing?
Yeah, sure. My father always used to write accounts in a traditional manner, and that brought me towards a professional degree, chartered accountancy, because he did not yield as much doing all the hard works and effort. So during my internship, I realized that the traditional auditing and accounting is not exciting me as much. Fortunately, I got into CRISIL as my first breakthrough, as my first job. Over there, I got interested in the industrial research. And from there, I picked up equities because in 2004, it coincided with the Indian equities and the economy starting to do well. So from there, I started picking up interest in how the businesses are running and then into equities.
Okay. Dhimant, as you mentioned, you have worked with CRISIL and another rating agency like CARE and even the Lotus AMC. So what were one of a few of the key valuable lessons which you have learned over the period of time?
Sure. So CRISIL and CARE had the ethos of credit research, right? Early during my career, there was a global financial crisis as well in 2008, 2009. So that brought at fore the importance of balance sheets and leverage into my investing. So now, having said that, of course, growth is very important while making equity investment decisions, but there is no part of growth if that comes at the cost of balance sheet or there are no adequate cash flow conversions. So profit growth is equally important, but at the forefront, that should be a balance sheet and a cash flow, which also should support this growth. So leverage and the leverage related ratios play equally important role for me, and that is what I have learned and ingrained very beginning of my career, especially when the short stint as Lotus was in 2008, where the debt crisis was at a peak.
All right, now moving on, can you describe your investment philosophy to us? What kind of stocks or market situations really get you excited?
Sure. So, firstly, I'll put up what we do at Invesco. So, Invesco itself has a proprietary categorization framework. There, we identify stocks based on its characteristics, and we link each of them to the financial parameters. So, we categorize or bucket the companies into leaders, high growth companies, turnarounds. We're buying it for valuation. We're buying it for commodity up cycles or down cycles. Those are the various buckets what internally Invesco uses, and this is a very broad framework under which we operate. We also have an ESG overlay onto that, so that covers your governance and the other E and S parameters as well. So that is what I operate on a professional basis into this company. But on top of it, yes, of course, there would be personal philosophies which would help me select the my stocks within those investable universe, right? So within that, what as I said, it will be the balance sheet and the cash flow statements which will be of equal importance to me in terms of investment. And I'll identify myself as a balanced personality. So growth at reasonable price or quality at reasonable price is what would be at my forefront in terms of the stock picking. Also, these days the dynamics are very fast moving. The world is changing very fast. So the sector rotation is very fast. So the companies have to be very relevant as well. So not only the companies need to have high runway of growth, but they need to remain relevant also, so that they avoid the terminal value challenges. There is a terminal value risk to many of the businesses these days, and many companies are struggling to keep pace with the changing environment. So that is also very critical for me, that the company has a long runway of growth, and effectively it innovates and invests itself to change and keep itself relevant to the changing dynamics.
But Dhimant, can you just elaborate a little bit on once the stocks are decided, how does it enter portfolio? What are the factors key factors which you look into the stocks before they come into your portfolios?
Sure. So usually, see, equities are bought for growth, right? So having a nominal GDP growth, you will have many stocks. So ideally, what I try to look at, that the company should have at least 1.5 times the nominal GDP growth, 1.5 times the return on equity upon the cost of equity. So the return on equity should be like 1.5 times your cost of equity. And of course, the quality needs to be very good, and it comes at a reasonable price. And what do I mean by reasonable? It's of course relative to the market. So XPE is a cheap PE at one particular point of time, but if the market moves up by 20%, that X also has to move up by 20%. So it's not an absolute cheapness of the stock, but yes, of course, we need to keep pace with the market valuations. But juxtaposing all the things, as I said, which is like growth, the runway of growth, the quality of the promoters, the 1.5 time parameter, what I called out on the growth. So 1.5 times the nominal GDP, 1.5 times the cost of equity should be your return on equities. All those things cumulative together what led me to the stock selection. So of course we do have 270, 280 stocks to dig in from and find the best ideas from. But yes, out of that 270 to 80 stocks, I have to then narrow down to my portfolio of 50 to 60 stocks, what I run for a particular fund.
Okay. Dhimant, now coming to specific funds management at the Invesco, you manage diverse set of
Sure.
funds like tax-saver,
Sure.
multi-cap, and hybrid. So can you just explain out to our readers what are the strategies you adopt while managing these funds?
So of course, the strategies that actually come in from the mandate of the fund itself, right? So if you talk about tax plan, of course, it's a diversified fund, but which doesn't have any restrictions on market caps. But if it comes to multi-cap, then there are restrictions on market cap, that each of the large, mid, and small bucket has 25% each of at least 25% each of these market cap buckets. So fund mandate is of paramount, which would eventually decide my stock positioning and the top-down positioning. Eventually, see, frankly, we do not take any cash calls at Invesco. And as I said, the internal stock categorization framework itself brings me the kind of stocks which I can own, or the investable universe what I can own. So of course that comes in from the two aspects, as I said, the mandate of the fund, which is of paramount importance, and then my internal stock categorizations. So that those are the two things on which the fund is created. What we run the fund is very much true to the label. So in a thematic fund like say PSU, I don't own any non-PSU stock, despite my mandate allowing me up to 20%. So what I am trying to build in is, if the fund is PSU, I want to run it as true to label. I have enough opportunities in play in PSUs that I don't need any non-PSU stock. So I have also been managing the financial services fund. There is not a single stock which is out of the financial services space. So we at Invesco keep running the funds at true to mandate and true to label kind of things. And that is where the things come into play. In case of hybrid funds, of course, there is a proprietary model which drives me what is the equity allocation that needs to be made. And over there also, I don't deviate the model outcome by more than 2%. So yes, there are guardrails in place in our system, which largely drives the fund structuring, and the mandate overall will drive the fund structuring. And of course, the parameters I spoke about in terms of my stock preferences, cumulatively that would make up the equity portfolios what I run.
Right at the beginning, you mentioned about your time at the credit rating agencies. So from your time there, could you share any early warning signs or red flags you watch out for when making equity investments?
Sure. So there are few things. Of course, those are all balance sheet related. See, frankly, the 2-3 things on the P&L side, as I said, the company needs to be relevant over a longer period of time, and the runway of growth should be very high. and there should be not very near-term or imminent terminal value risk. So that is very much important, and very short-term growth might not help if the company doesn't have visibility after 5 or 6 years. Then there is no point in investing into that company. More importantly, my red flags come in from the debt servicing part. See, we have seen the debt crisis not once, not twice, but 3 times, right, during the last 20-25 years. First was the global financial crisis, then came in the IL&FS-led crisis in India, then came in the COVID-led balance sheet challenges. See, there are many companies who have survived this P&L cyclicality, but the companies which are not able to get through, or those who have perished, they have all perished because of balance sheet challenges. So that again brings me to the same thing, that the red flags, whatever they come in on the financial side, that all boils down to the balance sheet and the cash flow conversions. And on top of that, of course, the promoter-led capital allocation decisions and the quality of the promoter do make a difference in terms of selecting a stock. So the red flags come in on a softer aspect on the capital allocation and the promoter pedigree sides.
Dhimant, recently, with the recent joint venture where 60% of stake was sold to IIHL, an 18-month lock-in period of remaining 40%. Do you foresee any changes in the management going forward?
Okay, so in terms of the management change, that we do not envision any management change, or the way we operate the investment process remained the same, right, since beginning, when we were Religare, that the investment process was written during that point of time. We became a joint venture under Religare Invesco, then we moved on to Invesco, and now eventually we will move on to this joint venture. The investment process and the way we operate it doesn't change. At the board level, of course, there will be board seats and the board level changes, but on the day-to-day basis on the management, Saurabh continues to remain our CEO. That is what is communicated throughout the organization. And two, of course, much more relevant to the investors, of course, is how we operate in terms of as an investment, as a team. So the investment process, as I said, remains paramount, and that there is no change which we are envisaging in the investment processes as well. So nothing changes per se. For me, it was a Religare visiting card which changed to Religare Invesco and then Invesco, and eventually there would be one more visiting card which would be changed, being in the same company. But frankly, for the investors or for the people at large, there will not be much change which would really impact the way we do business.
All right, now moving on to a few specific questions on your ELSS tax saver fund. 2002 was challenging, but 2023 saw a strong recovery for the fund. However, the first half of 2024 has shown only modest performance despite outperforming the index. What do you think are the factors that have affected its performance recently?
Sure. So let me start with 2022 and 23 as well, just to give the prequel. So in 2022, the market had actually run up way ahead of its fundamentals. That was very much evident that the P ratios had hit the all-time highs of 24-25 times. Even the India premium to the emerging market index was at all-time high. And at that point of time, the fundamentals were lagging to the run up what the equity market had. See, this fund is all about not only about creating returns or generating returns. The idea over here is just to beat the benchmark. That is, of course, paramount. But more importantly, the investors come in for tax breaks, right? So minimizing the drawdown also is equally important. That is where we had largely a large cap biased positioning in 2022. That actually took away some bit of returns in 2022 on a relative basis to the benchmark. But yes, eventually the things normalized. We came back in 2023. Even the earnings cycle gained strength over strength in 2023 onwards. So there were earnings upgrades also which were visible. The earnings cycle started to pick up in 23. And that is where eventually we got more opportunities in mid cap and small cap also. So you had that sharp correction in mid cap and small cap, and which eventually got us those opportunities, and we were back in the reckoning. 2024, 6 months, very short period to talk about, of course. But having said that, few of the bottom-up ideas did not go well. So not a specific sector or anything, but a few of the bottom-up ideas which didn't work as well as we were expecting. But yes, of late they have also starting to chip in. So yes, on a longer term basis, that all has evened out. On a 5-year basis, on a 10-year basis, we are above the average in terms of the peer set, and we are comfortably beating the benchmark on a longer term basis.
Dhimant, previously in our conversation with Amit Nigam, he mentioned that seeing a potential in the financial sector when the interest rates are falling. Yet there has been a notable decrease in the sector's overall weight in the portfolio. What prompted this shift, and what's your outlook on the sector going forward?
Sure. So frankly, outlook on the financial sector does not change materially. It is all about the relative opportunities what we are having, and having a disproportionate allocation to financials because the benchmark is very high. So in 2023, the balance sheets got cleaned up materially after the COVID-led baggage, and the lenders actually were in the best position. Your interest rate was rising, which actually helped the liability franchises of the few of the banks. So everything was in a good shape. The balance sheets were clean. They had raised capital as well. The tier one was also very strong, and the credit was starting to pick up. Now, frankly, it is a business as usual. So the outlook doesn't change on the financial sector, but we had a disproportionate 35% exposure to the financial sector. But having said that, the exposure has been shifted to industrials, where we had relatively better growth visibility and growth opportunity what has come up. So frankly, it is not related anything to the deterioration in the outlook for financial sector, but it is more that the opportunities in the economy has widened. And this usually happens when the economy is on the uptake, and the buoyancy is there in the economy. You will find many opportunities, and that is where you have to participate everywhere, so that you don't miss out one, and you are not you're well diversified, and you frankly do not rely on just one sector, which is frankly a risk mitigation kind of a thing. So it is just a tactical shift in terms of a big allocation on an absolute basis of 35% to financials. We have moved it down to 26%.
But you continue to remain positive with this sector, on the finance sector.
So we are very constructive on the sector. So nothing on the 3 C's, what I said, the capital adequacy ratio that continues to remain strong. The credit growth continues to be very healthy at 14-15%, and the credit cost continue to remain low. And in the foreseeable future also, we do not foresee any asset quality challenges to the sector. So the outlook remains very healthy. And that is why we still keep 1/4 of the portfolio in financials. Just wanted to add one more thing on the financials, that even the non-lenders are doing pretty good. This is to do with the financialization of savings, the increase in penetration of the non-financial of the financial products. Besides loan, of course, you see the penetration rise in mutual funds, the penetration rise in insurance. So that is also helping, and of course the buoyant capital markets are helping this capital market linked entities in the financials. So overall, as a space, it has been doing good, and that is where I said that 25% of the portfolio is allocated to financials.
Okay. Now we noticed that you've recently increased your mid-cap allocations even as valuations are high. So what opportunities do you see that justify this strategy?
Sure. So as I said, in terms of the stock picking, it is always growth at reasonable price and valuation and quality at reasonable price. The valuations, as I said, are relative in the overall context. We are seeing multiple opportunities in our economy, and when we talk about opportunities, we are talking about opportunities in India. So our portfolio is largely tilted towards the domestic oriented sectors, which are financials, industrials, and consumption. So these are the three main buckets where we are almost 65% allocated. Rest would be like 10 to 12% would be like healthcare, and another 3 or 4% should be utilities. Those two can give you diversification as well as some bit of stability to the portfolio in terms of defensives. So that is how our portfolio is created. See, India is going through a very strong earnings upcycle, which frankly was lacking during last 10 years from 2011 to 2020. So post-COVID, many things fell in place. The corporate leverage came down. The banking balance sheets are good. So both the lenders as well as the borrowers, we are seeing them in a good shape. We are seeing the corporates starting to invest. So the corporate capex cycle has also started to pick up. So we are seeing many more opportunities in industrial space as well. And see, frankly, we are a service-driven economy. Manufacturing, as such, is a very low proportion in the Indian economy, and therefore we have very limited large cap presence in industrials. So if you want to take advantage of the industrial upcycle or the corporate capex spend, it has to be through largely through the mid and small caps, because unfortunately, as I said, we are lagging on very huge opportunities in the we do not have many large caps in the industrial space.
Dhimant, we have noticed that out of 28 large cap stocks in the portfolio, around 21 stocks has less than 2% of exposure. So there are there any
Right.
plans of consolidation in the portfolio?
Sure. So a very, very relevant question. So if you notice that, as I said, the opportunities in the economy are very large, but at the same point of time, the valuations have also discounted more than a year now. Usually, equities discount 1.5 years of earnings, but this time around, we are a bit ahead in terms of valuations, in terms of the forward discounting. So we wanted to remain well diversified so as to mitigate the risk of valuations. And how do we do that? We diversify ourselves. And with the buoyancy in the economy, you will always find that there are many opportunities. So that is where we try to participate in all the opportunities. Frankly, time will tell whether all the opportunities are actually materializing or not. Of course, that also is an unknown kind of a risk. Are we seeing any headwinds? No, actually, the answer is no. But there are many opportunities, many narratives, and on basis of which the stock prices are where they are. So to mitigate the valuation risk and to mitigate the risk of slippages in growth or earnings downgrade, which the companies may or may not report. To tackle that, we have a longer or a diversified set of portfolio which has been created. Hopefully not soon, but as and when the economy starts to plateau and eventually slow down, that is where the consolidation phase starts of any portfolio. We frankly are not foreseeing any economic slowdown anytime soon. The foreseeable future looks very bright. So this long tail or a diversified portfolio approach will continue.
Since we are talking about tax saving funds, the category as such hasn't seen much growth in net inflows recently. So what strategies are you considering to attract more investors to these funds?
See, frankly, it is unfortunate that we do have herd mentalities. People do chase categories where the last 1 year return has been very good. And of course, the people are focusing on the mid caps and small caps as strategies. A few of the thematics have done well in terms of the industry flows. So that is the unfortunate part, that people do behave, the investors do behave in a herd mentality manner. But in terms of the tax saver fund, specifically what we are trying to do is educate the investor that this is not just a tax saving instrument. This is also a capital the wealth generation instrument as well, because equities are the only asset classes which can beat inflation over a longer period of time, and that has been, of course, proven by data and all that. But we are trying to educate the investors through various videos or materials that rather than looking at it as just a tax saver instrument, look at it as a wealth generation opportunity as well, because tax savers do not have any restrictions on market caps. They truly operate like a flexi cap category, right? So that is how the tax categories operate. And secondly, more important, usually the investor tendency is to put money on the last day, when usually in March, or when the tax proofs are called by the organizations. So we are also trying to educate the investors that SIP is a better route for rupee cost averaging for you. So that is what we are trying to educate the investors, that it should rather be coming in an SIP route, and in a more disciplined manner, rather than a last moment rush to get into the tax saving kind of a thing. So yes, hopefully this education will help the category as a whole, and eventually the flow should start to pick up.
Even coming to the specific PSU equities, as you mentioned earlier, your strategy and investment style, but coming to the PSU specifically, what's your approach towards the PSU equity, managing equity funds? Because there are challenges and there are opportunities in this kind of sector. So how do you navigate these things?
Sure. So PSU as a specific category, if you see, the one of the biggest opportunity and as well as the threat is they are very much dependent on the government policies. So what we try to do is be on the right side of the government policy, and try to align the investments in lines with the current policy of the government, what the government is currently focused on. In the last cycle, we had invested disproportionately in gas utilities. The gas-based ecosystem was created in India, and many of the gas utilities benefited out of that. So we did not have any traditional sectors like power utilities or defense or metals, or all those categories which were traditional in nature. The old school PSUs were lagging because of their own challenges, but the gas economy really picked up very well. This is because of the government support. So we need to be on the right side of the government policies. Secondly, if you look at PSUs, they are much more closely linked to the economic cycles. See, since 2011 to 20, the economic cycle was very checkered. We had all the issues like demonetization, implementation of GST, you had IL&FS crisis, then eventually COVID, and there was not a smooth runway in terms of your economic growth. On top of that, the fiscal deficit was also very high, and this tied down the hands of the government in terms of spending on the economy. So the fiscal spend on the capex was also coming down, or was very stagnated. Come COVID, these restrictions were taken off because pandemic is an exception, and the FRBM Act allows the government to deviate from the FRBM limits. And that is where this government took opportunity, started to put in capex. The agenda of this government was to make in India. That is where you see order books of defense companies and railway companies soaring up. So what we try to do is again be on the right side of the government agenda. And that is where you see a 30-35% exposure of PSUs into defense. So from a 35 to 40% exposure in gas utilities, we have moved to defense. So that is just an example that how we try to be on the right side of the government, and therefore generate a good return, opportunistic return for the investors investing into this category.
Okay, now the multi-cap funds, they are mandated to have 25% allocation each to small, mid, and large caps. Now, in a volatile market scenario, can you explain how do you balance this allocation between different market caps?
What we have tried to do is on the large caps, we have companies which have been, as I said, growing at a higher rate and have a better return on equities. That forms our anchor. And we have allocated close to 40-45%. So that percentage also differs through months, but 40-45% on a ballpark basis is to the large caps. On mid and small caps, we have again tried to diversify and have a longer tail, so that we don't face eventual single company risk. Because of course the outlook is very buoyant, but you don't know what eventually comes and hits you. the global dynamics are also very volatile. These days, you have Russia-Ukraine conflict setting, and you have Red Sea issues, you have Israel issue coming up, and hitting your portfolio. So you don't you are in a dynamic situation. You are in a situation where the sector rotation also is very fast in the market. So you don't want to be disproportionately benefiting in 1 month and disproportionately getting hit on another month. So that is where we are trying to have much more diversifications into play. And the mid and small cap tail is very, very large. And that is where the 60-62 stock portfolio is being constructed on the multi cap side. So at one hand, you have the large caps providing you the tanker, and the mid and small cap providing you that growth. And as I said, mid and small cap, currently the valuations are tad higher. So if the earnings downgrade come, then the hit also will be disproportionate. So to try to mitigate this valuation risk and the risk of the unknowns, we are trying to be much more diversified.
Okay, moving on to your strategy for equity savings funds. They aim to balance growth and income. So how do you achieve this balance in your funds portfolio?
So this category is largely meant for investors who usually prefer traditional fixed income routes or fixed deposits for their income generation. What we have tried to add is a flavor of equity. So these are very, very first time equity investors, which do not have experienced equity, or it might be for a senior citizen whereby you have some small portion of equity which can give you that additional return. The potential is a bit higher in equities, as we know. So that is the tad additional income, and of course the tax arbitrage gives you that the additional post-tax return into this category as against your other fixed income options. So that is what the strategy is positioned at. In terms of the equity, of course, the equity range is 15 to 40%. The benchmark has 35% Nifty. So ballpark, I do not deviate much above or below the benchmark of Nifty, which is like 35%. So my usual equity exposures are at 35 to 36%. And because it's only ballpark 1/3 of equities, the large portion of the returns are generated from the bottom up mid and small cap ideas. So more than 50% of my equity allocation. So if the equity is 36, 18% of the exposure will be to mid and small cap, through which you can generate accelerated returns over a longer period of time. So that is what the overall construct of the equity savings fund is.
And coming to the specific balance advantage fund, what triggers the shift between the equity and debt in this fund, and how do you mitigate the risk in that portfolio?
So in balanced advantage fund, for it being equity taxed, my gross long always has to be above 65%. So that is one. Two, we have internal proprietary model again in place, which gives me the what exactly should be my equity allocation. That no rocket science into that. Broadly, we encompass the factors or parameters like a forward P, a trailing PE, the trailing price to book multiple, and the yield gap between the G-Secs and the equity market yield. That is the inverse of the P multiple for Nifty. So these are the ballpark 4 parameters which goes into the modeling, and which eventually gives me how much equity exposure should I have, and on a net long basis. So on a gross long basis, if I am upwards of 65, which I'm mandated to have equity taxation, I keep hedging a few of the positions. If I need to go below the 65, in case the model shows that, and currently, of course, the model shows me 57%. So I am gross long upwards of 65, but the net long in terms of equity is 57%. So there is, of course, a model in place which guides me this allocations. And as a fund manager, we do not have any leeway in terms of overriding the model by more than 2%. So if the model shows me 55, I can either be 57 or 53. and not beyond this range meaningfully.
So right now the model is showing 57% in equity. So remaining 8% is your basically saying it's hedged.
Yeah, 8 to 10% is hedged. Of course, so you cannot be exact 65%. We have to keep some buffer. So 67% is the gross long, 10% will be your hedging position, and 57 is the net long.
Now, moving on to the last question, and
Sure.
the last fund that you manage, aggressive hybrid fund. So you have a higher equity component there. How do you ensure that the risk reward balance is maintained in this fund?
Okay, so over there, the range is 65 to 80% in terms of equities. Since I've been managing this fund as a lead, I have been keeping the equity exposures closer to 70 to 73%. I'm not very moving to the top end of 80 because the valuations are not as cheap or as attractive. But there are decent opportunities to have this fund equity exposure at upwards of 70%. Over there, it is ballpark 70-30 is what I have been, as I said, managing this over a longer period of time. And now in this fund, since the equity exposure is already at 70%, I do not want to take a mid and small cap risk over here. This fund is managed like a flexi cap fund, but it is more currently biased towards large caps because anyways I'm taking higher equity risk equity exposure in terms of this fund as against the equity savings fund. So equity savings is at 35%, this fund is at 70%. So I'm already at 70%, and the investor usually comes in with a balanced approach in terms of having exposure both to equity and debt. So I don't want to just focus on the return part of it. Of course, over here also, I do take care of the drawdowns, and it should not be as volatile. So over there, the fund is currently large cap biased.
All right. Thank you, Dhimant, for taking us through your strategy for each of these funds. Time for us to wrap up this chat now. Thank you for taking the time and joining us for this interaction.
Thank you, Ruchira. Thank you, Chirag. It's always my pleasure.